Hey everyone, it's Kristen with Gunderson CFO and Bookkeeping. This week's education topic I want to talk to you about is 401k. A lot of small business owners, they go ahead, they don't have a 401k, they don't have an IRA. They go ahead and put all of their money back into their business. They're like, I'm just going to sell my business and that's how I'm going to retire. Well, I don't want to be the bearer of bad news, but when people go to list their business, only 30 to 40% of those businesses even sell. A lot of businesses just close the door and they shut down and they don't sell at all. So that retirement that you've been working so hard for, building up that business, building up that baby for so hard, normally, 60 to 70% of the time just closes the doors and you have nothing, no cash flow coming in, no sale from selling the business. So they have nothing. The same thing for people who do real estate. They're always like, I want that money to be able to go in, to be able to buy another property. I want to go buy another property. They're putting all their money back into their business, doing either their small business or their real estate. They're not funding their retirement at all. So I wanted to come talk to you today about having a healthy middle. And I'm going to show you what that means. Let me go ahead and share my screen real quick. So you want to have a retirement, an IRA, like a Roth or a traditional retirement account, and you want to have a 401k. You want to have both, okay? It's part of building your retirement plan. So here's the trifecta. When you're part of when you're my tax advisory client, I have a trifecta for you. I build one out for you and where you want to be in the next year for that we can work towards that. So a trifecta is basically you have your trust down at the bottom. That's where the 1040 is. Over here on the left, you have your business, your S Corp. If you're into real estate, over here, you're going to have that in an LLC. But then the middle, you want to have a 401k, retirement, HSA. And if you know about self-directing or want to talk about self-directing, you can also self-direct all of those accounts. And that's what I love. I just started getting it. I just found out about self-directing about 8 or 9 months ago, and I've been doing it ever since. And now my whole family is doing it also. So I want to be able to help my clients do that also. Okay, so what are the 401k options for small business owners? The first one is a solo 401k. You can have a SEP. I don't really recommend them. There's only one time I do, and we can talk about that if it applies to you. There's also a simple IRA and a simple 401k. There's group 401k, profit sharing, etc. There's a safe harbor 401k, and then there's the pension / defined benefit plan, cash balance plan. Really what I want to focus on today is the solo and the safe harbor 401k. So I'm going to be going over those at the end and who's a good fit for each one, okay? Okay, so 401k strategies. If you're going to self-direct, invest in what you know. So I met a couple who owns a whole bunch of real estate properties. Whenever they have more money, they buy another real estate property. What I would suggest to them is open up a self-directed 401k, a solo, or even a Roth IRA, and go ahead, fully fund those, and then buy your next property with your 401k, especially if it's a Roth. It's going to grow. You don't get a tax deduction for it now. You pay taxes on it now, but then it's going to grow tax-free. So all the rental properties money is going to go in each month. And then when they sell it, that property is going to go back into the Roth. So they can really fund that quick by the rental properties and be able to fund it a lot quicker than doing Wall Street, right? So invest in what you know. So if you know real estate, buy rental properties and put them in there, or you can do a few fix and flips a year, or maybe you know people who are really good at creating companies like into software or gaming. So invest in what you know. The second option strategy is save taxes via contributions. So this is on the traditional side. A lot of people, well, I'll go more into depth in each side. You can borrow from your 401k. There's Roth contributions, then you can utilize the 401k UDFI loophole. So I'll explain that all a little bit more later. So again, invest in what you know. You can do self-directing in any of these, the solo 401k, the SEP, the Simples, the group 401ks, the Safe Harbor 401k, and the defined benefits plans. One thing I do want you to know, if you are just getting into learning what self-directed is, what that means, there's a thing called prohibited transactions, and it's in the IRS code 4975. So there's a whole bunch of prohibited transactions, not a whole bunch, but like people that you can do deals with, and then like you can't do anyone in the line. So you can't do your parents, you can't do deals with your parents, your spouse, or your children. And then you cannot invest in things like antiques, collections, or buy a property that you already own. All of those would be prohibited transactions. Okay, the second option for y'all is you get to save on your contributions. So if you're putting in like a lot of people, they're like, oh, I need to go buy a new truck or a new piece of equipment in order to save money on taxes. Well, a lot of times they're spending money they don't have to pay down taxes. And they may or may not need that equipment or that truck, but it's going to depreciate. Whereas if you're putting it into your 401k, you get the deduction now, and you also have it for your future. So it's the best option if you really want to have that tax deduction now to save on taxes, but you're going to have it for the future. So this is a really great option for you if you're always trying to figure out how to pay less on taxes. Okay, so here's what you can contribute. For the solo 401k, you can contribute $23,000 a year plus 25% of your W-2. So whatever your W-2 amount is, you have to have earned income. You can also contribute up to 25%. The other one I'm going to focus on is the Safe Harbor, the 401k. So that's $22,500 plus a match of 3 to 6%. All right. So the third option for y'all is that if you have money in your 401k, you can borrow from it. You cannot borrow from an IRA, but if you have money in your 401k in the business, you can borrow from it up to 50% or $50,000, whichever is the lesser amount. So a lot of times people will fully fund their 401k in their business and then borrow against it and re-put that money back into their business. So you do have to pay that back in 5 years. You have to pay that back within 5 years. And then it's also interest plus prime. So the interest is prime plus 2. But that's a really great option for some people who want to have that money to go back into their business. Okay, the fourth reason is Roth contributions. This is what I always recommend. If you're not concerned about having the tax deduction this year, you get to put the money in, you put the money in, you pay for the taxes now, like it's in your income, and then the money grows tax-free for all the years that you can put it in there. You can take it out at 59 and a half, and then you don't pay any taxes on whatever the growth is. So this is the way you can stick it to the man. So I always recommend doing the Roth side if you can. And then there's nothing with the IRAs, you have income limitations. With the Roth, with the 401k, you do not have the income limitations. And just for you know, if you do not know this, there is a thing called a backdoor Roth. So if you're contributing to your IRA and you're doing the traditional because you think you make too much money, there is called a backdoor Roth where you put it into your traditional first, and then you backdoor it into a Roth, and you do pay the taxes on it, but then it's in your Roth this year, and it's going to be growing. So this year, I literally, everything that was in my traditional IRAs, I went ahead and converted to a Roth, did the backdoor. So I'm paying the taxes on everything this year, but now everything that's going to be growing, because taxes are only going to go up. But I also assume my money is going to go up because I'm self-directing it. So when I take it out, it's going to be worth a lot more, and then everything will be tax-free when I take it out. All right, so those are the limits on everything if you wanted to look at that. So for the solo 401k, it's lesser of the W-2 or 69,000 you can contribute. And then for the Safe Harbor, it's 23,000. And again, anything, like if you have a simple IRA opened, or if you have a Roth, like a regular IRA open, or if you're doing anything, or I also have a 401k set up for my whole staff and myself that is not self-directed. Anything is better than doing nothing. A lot of small business owners do absolutely nothing. So any retirement that you have is better than doing nothing and just hoping and praying that you can sell that business, or that you can sell those apartments and houses down the road, and they'll be appreciated and worth more. Okay, the 401k option number 5. You can utilize the 401k UDFI loophole. So what this is say you're self-directing and you only have $50,000 in your 401k, and you want to buy a rental house that's worth 100,000, and you want to pay cash or you want to pay for the whole thing up front, but you can't. So you can actually get a loan. And it's kind of funny because, if you to go buy a mortgage anywhere else, you need to have it collateralized, like you need to have a personal guarantee on it. When you're doing it with your 401k, I can't remember the exact name of it, but you can't put a personal guarantee on it. It's a little bit more higher interest, just a little bit. But basically they take whatever the property is, like that is collateralized, and they can see what the property is worth and everything. I think you have to have a little bit more down. So you'd have to have, like, I think a 40% down payment if you want to do a loan, but then there's no self-guarantee on it, which it's so awesome. But anyways, you can do the same thing with your Roth. However, if you borrow money to be able to buy a property or a business, there's the UDFI tax rate, and they tax you at 37% of whatever the profit is for the percentage that is borrowed against. If you do it in your 401k, the UDFI, there is no UDFI, like it's exempt from paying UDFI tax of that 37%. So that is really cool if you want to go ahead and borrow money to buy property to be able to put back in to your retirement. Okay. So level 1, and everyone may not be interested in self-directing. You may not be comfortable. That's not your thing. Go ahead and go to the traditional the traditional markets and go through Wall Street. Have that financial advisor helping direct your money, because again, anything is better than nothing. So everyone should at least have a traditional IRA and a Roth IRA. And if you qualify, I've already done a thing on this, if you qualify for a health savings account, so I won't go into detail on that, but everyone should have that at the bare minimum. And if you can self-direct it, great. If you don't want to self-direct it, that's fine too, at least have it. And then the level 2 is if you have no employees, this is where you qualify for the solo 401k. The other options are the SEP or the DB cash balance plan. Again, I'm really just focusing on the solo versus the safe harbor. If you have employees, you do not qualify for the solo 401k. However, you do qualify for the safe harbor 401k. And that's what I would recommend. And again, you can self-direct these if you want to. If you don't, that's fine. Set them up with a plan administrator, and they'll run everything for you. All right, so which is best? I'm gonna just for the solo 401k, the upside of it is you can self-direct it. This is relatively simple setup and admin. It's great for the mega backdoor Roth. This is where I was telling you, and I actually did this. I had traditional IRAs that were old 401ks back, whatever, when I had worked as an employee before. So I had that sitting there in a traditional IRA, and I never did anything with it. Held it at Edward Jones with my financial advisor there. And what you can do is you can move it over into a solo 401k, and then you can only do it if it's a traditional IRA, and then you can backdoor it into the Roth. So that's what I did, and I'll be paying taxes on that this year. So you can do that with a solo 401k. You can have a participant loan, and then there's no UDFI. That's real estate only. And then the downside is you can't qualify if you have employees. And if you have multiple businesses like I do, you're gonna have to go through a lot of red tape in order to open it. Like your other businesses need to have a 401k plan for them. If you're gonna have a 401k, they need to have one that they can participate in. So I did meet all of that criteria, but it was a long list that I had to make sure that I covered and got across to be able to have a solo 401k. So I have two plans. One's a regular one, plan administrator with all of my employees, and then I have a solo and another business of mine. Real quick, here's the step. If you want to look at that, the upside of the defined benefit cash balance plan. Here's the simples. Again, anything's better than nothing, but the other one that I recommend, the group 401k. And just for you know, if you have a group 401k, there is a IRSA thing, where you have to, there's a little bit more admin that takes place. Like you have to meet all these qualifications, make sure it's not top heavy. So, and again, there's admin costs to that. So if you want to do the group 401k, and then the mega backdoor Roth is difficult. But this is what I do have for all of my employees, and myself. Okay, and then if you have employees, the other one that I recommend is the Safe Harbor 401k. So the upside is you can self-direct it. Decent contributions, again, the 22,500 plus the 3 to 6% match, the employer match. You can do the Roth or the traditional or both. It's relatively simple admin. You can do the loans. There's no UDFI, and then the admin costs are reasonable, and you get that tax credit. The downside is it's not good for a mega backdoor Roth. All right, so just to reiterate again, level 1, everyone should have a traditional and or a Roth IRA. And if you qualify for the HSA, I would open them up. And if you want to self-direct it, I would recommend doing it. But again, not everyone's ready for that. The second level is if you do not have any employees, I'd recommend the solo 401k. And then if you have employees, level 3 would be, I would recommend the Safe Harbor 401k plan. All right, I hope that was helpful to you. If this is stuff that you're interested in, I highly recommend you book a discovery call with my staff to see if we'd be a good fit. This is my advisory stuff. This is what I love to do. Ultimately, discovery call, and then if you're a good fit, we can book a comprehensive consultation where I'm going to be doing your own trifecta plan for you of where you're at and adding in where you want to be in the next year. We're going to couple with an action list of, I'm going to ask you a whole bunch of questions, a ton of questions. I want to see the whole big picture of where you stand, your family, your debt, your savings, your business, what you're making, what you're paying on taxes. We're going to look at your medical, it's going to have to be an open book conversation. It can be Zoom or in person, about an hour and a half. And then I'm going to come up with an action list for you. And then we'll have a second meeting. It's about 30 minutes long. And I'm going to go over your trifecta with you. This is what we discussed. And then we can work together on a monthly or quarterly basis going after that if you would want to, or you can implement it, the action list then they'll give you yourself. All right. If you want a discovery call, go ahead and book it. I'll provide the calendar link below. I look forward to meeting you. Bye-bye.